127% return in 2025, 39% return during the 2022 bear market when the NASDAQ dropped 33%. Those are the numbers people lead with when they talk about Vector's flagship system. But the more important question is, how do we do that? What is the system actually trading? How does it make decisions? How is it structured? That's what this video is going to cover. By the end, you'll understand the full mechanics of grass-fed prime beef, Vector's NASDAQ futures algorithm. From the ground up, you might be wondering, what even are NASDAQ futures? How are they different from something like QQQ? When most people hear NASDAQ trading, they think of QQQ, which is the ETF that tracks the NASDAQ 100. You buy shares, you hold them, you hope the price goes up. That's how most of retail investors interact with NASDAQ. Futures are a little bit different. A futures contract is an agreement to buy or sell an asset at a specific price on a specific date. But in practice, what traders are really doing is speculating on the direction of the market, up or down, within a defined time window. The specific contract Vector trades is called NQ, which is the NASDAQ 100 E-mini futures. It tracks the same 100 companies that QQQ does, Apple, Microsoft, Nvidia, Amazon, and so on, but it's a different instrument with different mechanics, different leverage, and importantly, different tax treatment. One key distinction with futures, you can just as easily profit when the market goes down as when it goes up. You can go long, betting that the market will rise, or short, betting on a decline. The algorithm does both. That's part of why it was able to generate positive returns during the 2022 bear market. You might be asking if Vector also has algorithms for Apple, Tesla, Nvidia, Amazon. Why is the flagship system trading the index instead of these individual stocks? And that's for a few reasons. First, NASDAQ is one of the most liquid markets in the world, meaning you can enter and exit really large positions without meaningfully affecting the price. For an algorithm executing at speed, liquidity matters enormously. Second, trading an index means you're not exposed to single stock risk. A company can miss earnings, get hit with a lawsuit, have a bad press cycle. The index absorbs all those individual stocks, and so nothing can affect it just from one company that much. You're trading the collective movement of 100 companies, not betting on just one of them. And third, the NASDAQ has well-established behavioral pattern around momentum, which is exactly what our algorithm is designed to capture. One of the three questions that we most often get is, why only one trade per day? Doesn't more trades mean more opportunity? Not the way that the system is designed. Grass-fed prime beef is built around precision and not frequency. The algorithm waits for a specific set of conditions to align. When they do, it takes one trade. When they don't, it sits in cash. There's no pressure to be in the market. There's no quota to fill. This keeps risk tightly controlled. You always know the maximum exposure for any given day because there's only one position that's going to be open at a time. It also filters out what I'd call noise. Trades that technically meet a threshold but don't really have strong conviction behind them. The result is a 76% win rate on the trades that it does take. That's not a coincidence. That's what selectivity looks like in practice. Now let's talk about how the algorithm actually decides when to get in and out of a trade. Without getting into the proprietary details, here's the framework. The system is momentum based. It looks for moments when the NASDAQ is showing a clear directional bias, either building upward pressure or downward pressure, and it enters in that direction. Once in a trade, two things govern the exit. The first is a dynamic stop loss, a predefined risk limit that adjusts based on market conditions. If the trade goes against the position by a certain amount, it closes automatically. No human needs to make that call. The second is a dual profit target. The system has two levels at which it takes profit. The first level is hit, part of the position closes, locks in gains. The remainder runs towards the second target, which is higher. This allows the system to bank partial profits while still capturing larger moves when they develop. Entry, stop loss, both profit targets are all determined by the algorithm at the moment that it enters a trade. No manual trade intervention, no discretionary decisions mid-trade. Here's one of the most underappreciated features of the system, and what I want to make sure lands clearly. Every position grass-fed prime beef opens is closed before the end of the trading session. The algorithm does not hold overnight, does not hold over the weekends. It ends every day 100% in cash. Why does that matter? Overnight risk is one of the biggest hidden dangers in trading. Earnings reports, geopolitical events, wars, Federal Reserve announcements, these things happen outside of market hours and can cause massive gap moves at the open. If you're holding position overnight and the market opens up 3% against you, your stop loss does not protect you from that gap. Grass-fed prime beef eliminates that exposure entirely. Whatever happened overnight, you weren't in the market for it. You wake up flat every morning, no exceptions. Now, I want to address something that surprises a lot of people: the fact that this system profits in both directions. Most retail investors are only comfortable thinking about making money when markets go up. Futures trading does not work that way. Grass-fed prime beef takes long trades and short trades. The algorithm doesn't have a directional bias. It reads the conditions and trades whichever direction the momentum supports. This is why the system was able to generate a 39% return in 2022, while the NASDAQ dropped 33%. That's a big difference. When the market was in a free fall, the algorithm was shorting it and profiting the entire way down. It's also why the system's performance isn't tied to whether we're in a bull market or a bear market. It's designed to find opportunity no matter the environment. The last thing I want to cover, and that is really worth paying attention to if you care about after-tax returns, is the tax treatment on futures. Futures contracts in the US receive what's called a 60/40 tax treatment under section 1256 of the tax code. That means 60% of your gains are taxed at a long-term cap gains rate, regardless of how long you held the position. The other 40% is taxed at the short-term rate. For context, if you were day trading stocks, 100% of your gains would be taxed at the short-term rate. Futures traders get this blended rate that is almost always lower, often meaningfully, so depending on your income bracket. This is a structural advantage built into the asset class, not something vector engineered. It's a federal tax law, but it's a real benefit that adds to the after-tax return of the system. As always, check with your tax professional on how this applies to your specific situation. Grass-fed prime beef is a system most people come to Vector for first. Hopefully this video gave you a clear picture on what it actually is, how it thinks, why it's structured the way it is. If you want to see the full performance data, monthly returns, drawdown history, live account statements, the next step is a free walkthrough call. We'll go through everything and you can ask whatever questions that you may have. The link is in the description.